significant one. This is a panel exploring transforming transactions, headline deals during the pandemic, and I'm pleased to introduce you to our distinguished moderator, Laura Paw. And Laura just finished a distinguished career at Marriott International, retiring as the Senior Vice President for Investor Relations, and she'll be introducing the rest of the panel.
Thank you. So we're going to talk about transforming transactions, which is absolutely fascinating given the period we've been through. With us today, to my left, is Gary Axelrod, co-chair of the real estate practice for Latham and Hospitality, Gaming, and Leisure Industry Group. While he is particularly focused on advising on lodging transactions, he's experienced with all types of real estate and asset classes, domestically and internationally.
Wow.
A global, worldwide person. Anyway, Matt Gunlock is principal at Highgate, a firm with over 350 properties owned or under management. Actually, I think that number is
the number went up,
isn't it?
as
Yeah,
of this morning.
it's going up. North America, the Caribbean, Latin America, and Europe. You may recall Highgate's acquisition along with Cerberus. Thank you, Cerberus Capital, of the Dorset City London Hotel last year for £115 million. Also last year, Highgate opened the 286-room Newberry Hotel in Boston, which was the former Ritz-Carlton, one of my favorite hotels. So I'll have to try out the Newberry. He has 15 years in commercial real estate. Larry Kwong is managing director at Moelis & Company, 14 years investment banking experience working on U.S. and international transactions, including M&A, recaps, restructurings, and capital raises. And then finally, Dan Lesser, president and CEO of LW Hospitality Advisors, so leading authority on hotel feasibility and valuation. For those of you who have done your homework and read all of the attachments that we provided ahead of this panel, you understand the extraordinary breadth of Dan's insights and knowledge of this business. So my role here today is to hopefully ask some penetrating questions, and I hope that the group everybody will sort of have talk with each other, and I hope to engage many of you, and I would love it if we could get the first question from our virtual audience. Before the end of the conference, please let us know you're out there and call in with a question, okay? All right, so first for Matt, tell us about this deal.
Happy to, and our esteemed counsel over here from Latham, Gary, should feel free to jump in.
I'll correct you.
Correct me if I'm misstating anything.
I got you.
All right, thank you.
I'll keep it in trouble.
I don't know how Gary's actually standing today because we managed to close two major deals this week, only one of which was in the hospitality space. But this morning announced the closing of the acquisition of Core Point Lodging Group, 130 La Quintas. What was the headline price did we put on that?
$15.99 per share.
There we go. Okay.
Someone else can do the math.
Someone else can do the math on that. And then also, because I mentioned the other deal, acquired a $3.2 billion portfolio of healthcare assets earlier this week. So, like I said, I don't know how Gary's still standing.
So some people have said hotel valuations are frothy. I think that came up yesterday. Obviously, you don't agree because you just did a big transaction. So what do you think?
Definitely, we're still very active in the buying space. I think when we talk about transformative transactions during the pandemic, I come back to our acquisition of 200 select service assets from Colony Capital, now Digital Bridge, which we agreed to the terms of that deal before there was even any vaccine news, and no one was buying in the space. But I think if you rewind to mid-pandemic, the notion that we would be sitting here today and talking about the numbers being thrown around from a valuation perspective, just crazy. But a reflection of the fact that the world is very much awash in capital at the moment, and I'm sure you gentlemen would agree with that.
I would agree with that.
But I think part of it, Matt, is the asset class that was at play, which performed better during the pandemic. The limited service, select service,
Yep.
And the opportunity. I mean, Core Point was a highly contested bidding process. It wasn't like you were an outlier.
Right.
There's ample capital in an asset class that is ripe for riding through dips that we just
Quickest to ramp out of the pandemic, a little more resistant to the bumps from a demand perspective. And I think, when I look at it from Highgate's perspective, and we've always been known as being a full service manager, not a select service manager, there were learnings through the pandemic about operational efficiency that we were able to bring to bear on the select service base. So that was the thinking.
And I think the difference between the Colony deal last year and the CorePoint deal this year is the financing element. During the pandemic, hard to get financing for a deal of 200 hotels valued at $3 billion, but it had all assumable debt. So that made that acquisition harder from a transactional perspective, but easier from an economic perspective to not have to originate new debt with a very uncertain period of time.
Absolutely.
So Larry, are you seeing deals today that are generally multi-unit deals like this, or are people still doing a lot of one-off hotel transactions?
Both. So I think if you looked at the single asset hotel market last year versus the year before, it was up. And then you compound on top of that these large portfolio transactions, and it's way, way up. And the reason why is because of what Gary mentioned, just the availability of financing in the market. Very cheap financing has basically favored institutional investors like Highgate, guys who could sort of not just process and do big deals, but pay for them as well. And so I think it's one of the reasons why we're seeing some of these billion-dollar plus portfolios hitting the market almost in rapid fire succession. There's probably another 3 that are on market right now, another 2 or 3 that I know of that are sort of coming out. And again, it seems contrarian to invest in hotels in the middle of a pandemic, and we're still not out of the woods yet, right? It's just like your hotels are doing great, but they're not where you expect they're going to be, and they're definitely not where they were pre-pandemic. But what you're seeing a lot of real estate investors do, and this is good news for anybody in the room who's in sort of the hotel deal space, it's a relative value play relative to other real estate asset classes. People are still scared out of their minds with commercial and retail. It's really very difficult to touch, but we've all seen multifamily, much more sort of stable, simple asset class, industrial, all trade to like astronomical levels where the returns are very thin. And you look at select service hotels from a yield perspective or any kind of hotel relative to that, suddenly it starts to look very, very interesting. So some of the investors that we're seeing now who, unlike Highgate, aren't necessarily hotel or operating real estate specialists, are really guys who are sort of playing the relative value game and saying, you know what, multifamily is feeling very expensive, but I could generate a pretty interesting yield and some interesting income off of operating real estate like hotels at a point in time where I think it's more likely that things are going to get better as opposed to worse. And I think that's a lot of what's driving it.
So Dan, how does one do a valuation today with earnings kind of at a trough level?
No different than it was done in the past. I mean, at the end of the day, hotels are income-producing forms of real estate, and it's all about cash flow, and more cash flow. Just to sort of elaborate a little bit further on the transaction market, and I'd like to also comment on the frothy aspect of it. I get posed with that all the time. Well, isn't the market frothy? And my answer to that is always call it whatever you want. The market is the market, right? And the market speaks, right? So whether somebody perceives it to be frothy or not, that's really not relevant. Sophisticated buyers and sellers and lenders are negotiating transactions at whatever pricing is. So it may be frothy, but anyway. So I'm going to just read off a couple of statistics because these are quite mind-boggling. 2019, right? So this is pre-pandemic. I do a major sales survey, $10 million or more individual sale transactions. This is not allocations from portfolios. In 2019, I tracked 164 individual trades, $10 million or more, $17.7 billion, average sale price per key, $364,000. Just sort of think about that as a backdrop. 2020, right, the year of the pandemic for the most part, 79 trades, so half of what it was the year before, $5.3 billion in total. That was down 70%, 70. Sale price per key, $273,000, 25% lower than 2020. 2021, I mean, these are astonishing statistics. First of all, 2020 is astonishing because of how it fell off a cliff, but 2021, there were 308 individual $10 million or more transactions. That's threefold of what happened pre-pandemic. Total transaction volume, $36.2 billion compared to 17.7 in 2019. So the transaction market is absolutely on fire, and the average sale price per key, $431,000 in 2021.
Dan, that sounds frothy.
That's the market. That is the market. I just also want to sort of pick up on the CorePoint transaction and the Colony. CorePoint was negotiated, well into the pandemic. Your Colony deal was, as you said, there was no financing, and it was early in the pandemic days. The one portfolio you didn't buy, I was the court-appointed receiver for the CHOP portfolio. It was 48 assets, and I got involved in that in June of 2020. My phone ran off the hook with all sorts of intermediaries who wanted to sell parts of the portfolio or all of it. There was no interest on behalf of the lender at that point in doing that. And then I was getting a lot of calls from regional folks interested in one here, two there, what have you. As we went through the pandemic, and I would say that by March, April 21, there really weren't that many sort of inbound inquiries of folks interested in the entire portfolio. A light switch went off in March, April 21, and all of a sudden I was fielding an incredible number of calls from folks who were all of a sudden interested in the entire portfolio. So again, as we went through the pandemic, talk about volatility, right? 2019 fell off a cliff, and now we're way above 2019.
So there's a lot of unknowns as you look at the operations of the given hotel today. When will they get back to 2019 RevPAR? What will margins look like? Are we going to end up having to clean rooms every night? How do you incorporate that when you're doing evaluation? Anybody?
Depends if you're the owner or the lender.
Mm-hmm.
I think the owners have an expectation that the cost savings that they created in 2020 and 2021, reduce headcount, less services, they take that into account. They assume that the revenue...
The owners or the buyers are optimistic.
And lenders, I think, are still discounting that.
Perhaps sellers as well?
Sellers as well.
Mm-hmm.
But there's so much capital on the sidelines still that sellers are running great processes, and they are making people really drive the price up.
Mm-hmm.
And there's enough capital out there to do that.
That's really what it is. I mean, there is so much money. I've been doing what I do for, I hate to admit how many years, but it's been a long time. I dye my hair gray, but it is my hair. I've never seen so much money from all parts of the world for all parts of the capital stack chasing hotel deals, debt, equity, what have you. Just look at some of the most recent announcements, right? The W in Nashville, $950,000 per key. That's kind of mind-boggling when you think about it, right? The Van Zandt in Dallas, I believe, yes. It's a nice hotel. It's a real nice hotel. $750 a key. So there is some, and these, by the way, these are public entities that are buying these assets. These are sophisticated investors, hotel-centric. They don't just dabble in hotels. It's pretty remarkable. And then, of course, if you look at Starwood and Blackstone and how they're teaming up and doing what they're doing. Yes, one of yesterday's panels talked about cycles, and as I was listening to it, I was thinking about, I'm not really sure if I believe that there are cycles, because you look at a group like Blackstone, right? Blackstone is always in the market, buying and selling, always. So I don't really know whether there are cycles.
Well, I think also, what's a cycle anymore? When you've got these intervening events, it's almost like a glitch in a video game. Suddenly up is down and left is right. And the pandemic, we have been transactionally extremely busy since 2011, but then you had the pandemic and you've had now Ukraine, you've got all of these instances that sort of restart, shorten that or cut off that growth. And then it's almost an unnatural resetting of the cycle. And so one of your questions is, what inning are we in? I don't even know what game we're playing anymore.
Plus, when you look at the asset type, right? Downtown urban core hotels, right? Large big box convention hotels are still taking it on the chin, right? Unlike the Colony stuff, right? Select service, extended stay, drive-to resorts, right? They're at the other end of the spectrum. quite frankly, I think that's where the smart money should go now, is into downtown,
I agree, yeah.
urban core, 24/7 markets that are beaten to hell. That, listen, you better be ready, willing, and able, if need be, to hold on for 10 years.
But the capital flows have been very predictable in the space, meaning like there's a reason why it's like the luxury resorts on the one end and sort of the select service hotels on the other hand that are going first, because those recovered fastest and they're generating cash. But to your point, I still think that we're very early in this M&A cycle, because there's that entire center of the market, that sort of full service lifestyle boutique, whatever, in every single market that basically hasn't been touched for now 4 years, right? I mean, like we're sitting here in 2022 and everyone says like, well, what's 2019 performance? Like when we were sitting in 2019, nobody was asking what the performance of a hotel was in 2015, but it's basically the same thing. But you look at now, like what's happening with these full service hotels, and you could comment on it from your portfolio, but they're starting to turn the corner a bit. They're starting to generate a little bit of cash, which actually takes a lot of hazard away from lenders being a little bit more disciplined about saying, hey, maybe now it's time to actually do something. We're starting to actually see that in a lot of urban markets. And so I think that's I agree with you. I think that's where people should be spending time in the second half of the year.
I think if you look at the Sheraton in Boston that recently traded for just under $200,000 a room, on a per pound basis, you couldn't replicate that hotel for anywhere near that. Right now, on a gross dollars basis, it's a lot because the hotel is huge. And there's going to be a lot of brain damage in sort of figuring out, okay, what do we do with this thing? How do we turn it around? And to my point, that money better be patient, because it could take quite some time to create value there.
So what's going to slow down the market? Do you think rising interest rates will tamper some of the demand for hotels? Anybody?
Look, I mean, I think there are a number of circumstances that exist today with which the industry must wrestle. You know, rising interest rates is absolutely one of those things. Rising input costs, I mean, just inflation across the board, right? I mean, we have probably today the most conditioned consumer in the sense that there seems to be real price inelasticity, right? Or I feel like everyone is used to things costing more, right? So there's probably more opportunity to take rate today than there ever has been. But what we don't know is how much all of the other input costs feed into that, and whether that can be offset. The other thing we don't know from a macro perspective is, will we see business travel return to 19 levels ever? We don't know the answer to that. Right, leisure travel has certainly come back in a lot of markets in a big way. I mean, we had markets that were performing by the tail end of 2020 better than 19 levels in drive-to leisure markets, which was fantastic, and I think to some respect unexpected at the time. But business travel, right? I mean, I have not seen business travel come back to the degree that it existed in 19, and I'm not sure. I mean, you can see investors shy away from urban core office, and there's a good reason for that, right? But in the absence of businesses being located in urban cores and having conferences and in-person events, I think that'll be a continued drag on some of that full service.
I think that
urban
feeds
market.
into what Dan was saying, though. That will come back. It's just a matter of how long.
Right.
But I think it will come back, and you have to play the long game in those types of asset classes.
And rising interest rates with a backdrop of inflation, if you think about it, that's going to only drive more money into the hotel space. Because what other asset class reprices on a continuous basis? No other commercial real estate asset class. And so, you know, it's proven when you look back over history, that hotels on a risk-adjusted basis are a great hedge against inflation.
Unless you get a lot of supply.
But that's pretty well in check at this point.
Right now it
Yes.
is, yes.
And you know, it's interesting when you talk about supply, because everybody talks about new supply.
Yeah, let's talk about new construction versus acquisitions, right?
No, but nobody ever talks about net new supply. Look at what's gone on in the pandemic and how many hotels have closed, literally permanently, been converted to alternative uses or scraped altogether. Now, there have also been a whole host of hotels that were announced to be closed permanently that are not closed permanently, right? I think the Hilton Times Square is probably a poster child of that. That's going to reopen as a hotel, right? But there's a slew of properties in California, in the state of Washington, that have been bought by municipalities, actually, it's some pretty healthy numbers to convert for homeless shelters.
And the new supply trend, I mean, that a lot of people have been talking about for the last 10 years is from alternative accommodations and sort of assets kind of outside of hospitality. And that's created a massive amount of phantom supply, which at sort of moments in the calendar has created issues for hotel operators. But from a broad spectrum perspective, if you look at the pricing power that hotels have right now, despite probably a record number of alternative accommodations, sort of home sharing companies out there, hasn't really sort of moved it. And so I feel like from a lot of perspectives, we're still all trying to discover how big the travel market is and how, what the desire is to travel. And certainly the pandemic, if anything, has created additional demand and different types of demand.
Do you think there's a real estate investment opportunity in alternative accommodations, the way there is in home purchases these days?
Yeah, there's a lot of interesting capital formation happening around that space. Whether it's, and you're seeing it kind of in the listed markets right now with companies like Sonder, companies like Inspirato. And if those companies prove anything, and we can all sort of debate the pros and cons of their individual business plans, they're all proving that there's people out there who want that product and they want to stay there. I think that there is progress and evolution to be made in terms of how those companies actually acquire inventory, whether the leasehold model makes sense, whether you should be aggregating capital and buying luxury homes and sort of releasing them out and distributing it through like a Marriott system or Airbnb system. But we are starting to see a lot of institutional interest around aggregating vacation rental supply. And the Brookwood deal, like the Extended Stay America deal, if you really think about it, that was sort of the pricing of an asset class that now sits somewhere between multifamily and hospitality. And so we're seeing this sort of further subdivision of supply that's creating, I think, new categories of interest.
Any questions from the audience or online? Anybody? Well, some of us here represent brand companies while we're very interested in what's happening around hotel owners. How do you think this the very strong demand for hotel assets intersects with the brand companies? When you buy an asset, how do you think about branding it, and how do you decide to brand it?
Well, I think an opportunity to buy something without a brand or that can be rebranded is more valuable, usually for the buyer and for the seller, frankly, because there's the opportunity to extract key money. Or if it's a brand that's kind of lost its luster in the area, to start something fresh. So certainly it plays a factor for pricing, and sellers market it all the time whether it can be bought unencumbered. So clearly there's a value ascribed to it, and it depends. If it's a good area and a good location, you see a lot of RFPs where you put the brands against each other and try to get the best terms possible, which is, presumably
are the
value
brands
accretive.
delivering good terms these days? Have they been more flexible in light of the lower hotel construction?
Flexible and brands, I don't know that those two words go together, so I'm not sure I follow you.
More flexible.
But
To your point.
I think they're willing to provide more key money, and they're willing to make more of an investment. And where I think there's a lot of value creation when dealing with brands is really on the PIPs.
Yeah.
And value engineering,
Or how
pushing
about
stuff
the
off.
length of the contracts?
No, that's pretty standard.
Pretty standard, okay.
The arena of buyers for unencumbered assets is much larger than encumbered assets. So for that fact, it pushes upward pressure on value because you have that many more folks interested. An interesting transaction to think about vis-a-vis encumbrances and non-encumbrances. Ventana in California, that Giolo put on the market, and they were able to sell it unencumbered, free and clear of the brand management. And Hyatt swooped in, paid a lot of money for it. It actually set a new record in the United States of a little over 2.5 million per key. And 6 months later, Hyatt turned around, sold it to Host Hotels and Resorts for 150 million, and they took back a long-term management agreement, right? And that was obviously a strategic play. They used their balance sheet to protect their branding of that asset for a long period of time.
I think this is a great, just a lot of the transaction activity is going to create great opportunities for the brands because, first of all, like the change of control gives you an opportunity to actually refresh the brands, but the change of control PIP in, which I think is painful for the buyer, but the buyers know it, so they incorporate it into their underwriting, but it's necessary to sort of progress the brands and to evolve them. And I think that this transaction activity should help the brands further that evolution. Let's hope that we see some of these older generation courtyards kind of get switched over to the newer generation courtyards. And I think it's important because one thing that has become at least crystal clear to me is that with all these select service and limited service transactions, brands are actually incredibly important. Like you don't hear a whole lot about unencumbered select service. I mean, I wouldn't want to stay in a independently operated select service hotel in some tertiary market, right? I want to stay, at a brand. And so I think that, and what I'm also starting to see is, we used to talk about the hotel industry as like select service, full service, luxury. And now it's like, all right, select service, are you premium select service? Are you discount? Are you mid-scale select? It's just this further division. And there's a big difference between whether you're an AC hotel or like a, third generation courtyard or things like that. I think that's going to continue, right? Because I don't know if it's occurred to all of you, but like select service hotels are like, newer ones are kind of cool now, right? It's just like, I'd be totally happy staying there. Like the room product is great. It feels like modern feel. It's got a bar in the front. Sometimes they have a rooftop. Like I think that product is evolving, and it couldn't happen at a better time, just given some of the labor challenges that the industry has. And I think the truth is that travelers, particularly when you think about, the Airbnb travel, like they don't need 24/7 room service. Like now, if I'm going to a resort, I want 24/7 room service, but I don't need it if I'm just going on a business trip. I just want a nice clean room and a fun experience. So
And convenient outlets.
And yes, that USB-C outlet is killer.
As the hotels are trying to drive down costs to enhance profit, do you find that limited service and full service are sort of looking alike?
I think there's definitely convergence. I mean, I've seen some select service developers put things into the hotels that I thought would only ever belong in a full service hotel. I mean, we're looking at a portfolio where somebody put an honest to God like rooftop club, ultra lounge on top of a select service hotel, and it doesn't make sense until you actually see it and you sort of see the numbers and say, okay, there is something to this. So I think that there will be convergence around that, particularly around anything that delivers a unique experience.
Do you think it puts it, the big box hotels, the 1,000-room full-service hotels, does it put them at a disadvantage vis-a-vis the limited service properties? I mean, if the brands start well looking the same, why would I pay a premium?
It's hard to imagine it doesn't, because you think about what people are, are they willing to pay? Are they willing to pay some multiple of the cost that it takes to provide a bunch of services that they don't necessarily need, right?
Yeah.
I mean, and I think that's definitely starting to compress.
How about soft brands? Are those of more interest to you today than in the past?
Yeah, I think they're fantastic. I mean, it's been great for the brands. I mean, it's been a great way for the brands to establish a relationship with hotels that otherwise would not have been comfortable being part of a branded system. And so I think that's a good example of sort of a win-win. And I know that there's a lot of independent hotels out there that without the benefit of distribution from a big brand would have struggled, and particularly through the last couple of years. That's been good for the industry.
So both Marriott and Hilton have made a big push into all-inclusive. Is there an opportunity here for real estate investment?
Yes.
Largely it's Caribbean, Latin America, but do you think there's an opportunity here in the U.S.?
In resort markets, I mean, I think with the all-inclusive, and everyone saw the Hyatt transaction with Apple Leisure, but for sure there is a lot of customer demand for that experience where they just sort of walk in and it's just like you're done. You don't have to swipe your credit card. You don't have to give everybody a room number. You just sort of swipe your thing and you're done. And so, and I think from a cost perspective, the margins on those businesses are fantastic. The experience is great, and it attracts like the resort guests, which is exactly what people want right now, and there's a lot of them. And so for sure, there's some opportunity there. And I know a lot of brands have been focused on that area.
Mm-hmm.
I don't think it's a new concept, though. I mean, Club Med has been around for how many years? Sandals, right? So it's really not a new concept. I think it's a new opportunity for the major brands to fill sort of a vacuum of a space that they don't have representation in. I know you're all excited about the question.
I'm all excited.
I know,
about the
it's
question.
amazing.
Oh my God, thank you so much.
The restrooms are in the.
And it's not Andrew.
The reason why I want to ask the question is because you're talking about all-inclusive, and an old colleague of mine, Tyler Morse, is going the exact opposite direction with the TWA hotel, which is the airline model. Give someone a basic fare. His quote unquote at NYU was, I'm giving them a $300 rate. They want a $500 experience. If they want the $500 experience, they can pay for it by paying for the amenities. You want to use the pool, you pay for it. You want an extra towel, you pay for it, and so forth. So I would like to segue from the all-inclusive experience, which is, what we're talking about, to the opposite of that. I'd like to know your thoughts on whether it makes sense to do it, or whether he's an outlier. Is that going to be a trend? That's my question.
Tyler's definitely an outlier. just as I feel like it's probably you and I.
I don't think I can comment on
And
this.
secondly, like I would never bet against Tyler, and so like he's actually gone fully the other way, which is like, do you really need to rent out a room for 24 hours at a time, or could you do it for shorter blocks? And so I think that there
That's
are
not a new concept.
Not
either,
for
by the
those
way.
reasons.
That's been around a long time. That's the
Dan, is
world's
that a frothy
oldest
market?
profession.
Yeah, I mean, I think, look, it's just, there's definitely a lot of ways to play with pricing. I think that I would argue that sort of an all-inclusive resort where you just want to like sit in your butt by the pool all day and just have drinks served to you. Like, and by the way, even an all-inclusive resort, like you can get the special colored band to get like the top shelf liquor versus the well liquor. So there's always going to be the ability to sort of add that pricing. I would argue that TWA is a different type of experience. I think some people are there just for the basics. They're there for a business meeting. Other people are there for a wedding. Other people are there because they want to live and have the experience of staying at the TWA hotel and having lunch on the Connie and things like that. And so in that context, TWA's got to be the most Instagrammable hotel on planet Earth right now. And so I would be monetizing the crap out of that if I were Tyler. So I think it's arguably a different type of product.
So Europe. Is the European market as strong and for hotel assets as the US?
Well, now that there's World War III going on there, I
Well,
think there's
I was going to get to that, but
anyway,
but prior to World War
So
III,
ignoring that,
ignoring World War III, prior to World War III, was Europe an attractive market for property acquisitions? I mean, for a long time, we've talked about, Europe is not as branded as the US, and it's moving in that direction. I mean, are there opportunities there?
Europe is like the market that all of us have been trying to figure out a way to unlock at scale for decades. Whether you're a brand and I think one of the biggest impediments there has just been capital formation around like triple net companies. And so you're neither an operator nor an owner there in a lot of cases. You're sort of an owner taking operating risk because you have the lease on it. And I think that's been a huge impediment in terms of like creating more liquidity in that market. Where there are fee simple assets that are for sale, like they sell well and they sell fast and they get a lot of interest because there's just a lot less stuff to look at, right? And I have a lot of clients who are constantly just like combing for opportunities throughout the continent, and there's just not enough to sort of look at. I know the brands for a long time have wanted to have a bigger presence there, but just the liability that you have to take on with the leaseholds is just not something that your balance sheet is designed for. And so the market is great. It's obviously there's a lot of opportunity there, but until there's some reconciliation around how capital is formed there, and the interest in kind of triple net lease businesses versus fee simple businesses, I think it'll be difficult to penetrate at scale.
And the debt markets are
Yeah,
feeding into
because
that,
right,
right? It's
tougher to
a
finance.
much more challenging market, lower leverage
How are they
levels.
more challenging on the debt markets?
Well, first of all, it takes forever to get anything done. That's an absolute certainty. But just lower leverage levels across the board. It is not nearly as efficient from a financing perspective as the U.S. markets are.
Mm-hmm. Okay. Would you build a hotel today?
We are building hotels today, so the answer to that question is yes. Obviously the thinking around that is driven in large part by questions around whether anything's able to be purchased, right, rather than built.
but Matt, you're at what scale are you? You're at the economy.
Yeah, select serve
Yeah.
ground up. Not big box, full service, urban centric. But a lot of questions, right? And this goes back to this question around inflation, right? I mean, anyone who's tried to build anything, I mean, even anything from a small CapEx project all the way to a full-scale renovation or a ground-up build, everything costs considerably more than it did, 12, 18, 24 months ago. And there's seemingly no end in sight for that. And that's assuming, by the way, that you can even get materials and labor.
Or get the labor to
Right.
build the thing?
Exactly.
Yeah. Okay. You know, I worked on a big transaction, seems like yesterday, but it was a long time ago, Marriott Starwood. Could a transaction like that happen today?
Not many left.
No, there are not.
I mean, that is one of the things, there's been so much consolidation in the industry on the ownership side and on the management side. Larry, you can probably speak to how many management company transactions you've worked on, but we've worked on 3 or 4 this year alone, and it's consolidating. It's at some point the brands, you know, how many brands does Marriott have now? 30 some.
Yeah.
Is
And
it
growing.
and growing?
Yes.
There's definitely still desire on the part of public shareholders to see some more consolidation. And so to answer your question, like there's definitely an investment rationale and strong industrial logic to see more of that happen. But as we all know, sort of doing deals like that, I mean, it's as much about timing, people in the room, you know, where that business is and sort of their strategic arc. And so I think all of us, it would be hard to imagine something like that not happening again. But I think it just highlights what a great transaction that was for Marriott. Just the fact that you don't see those things happening every single year. I think if you ask any public company executive, though, like, hey, do you have a dream acquisition or a dream merger that you'd like to do? Every single one of them has one, but it's very, very difficult to pull together. So I think the gravity of consolidation and the clear benefits of doing it militate towards more of that happening. But I don't know that you can rely on like seeing, you know, 1 or 2 a year, right? But it will happen, particularly since I think the branded hotel industry, like there's competition. There's competition from the OTAs. They are consolidating like crazy. There's consolidation amongst the alternative accommodations guys. Like there will be, I think, reasons to see more and more of that over time. And we forget, like, as much as there are like big, large, dominant brand families like Marriott, like Hilton, there's a lot of small brands out there too that will be looking for homes. And so I think anybody sitting in like a business development or kind of deal seat at these brands, like there's a lot to be looking at. You know, they're not going to be gigantic deals like Starwood, but there are definitely a lot of very high quality brands out there that I think over time will need to look for a home.
Yeah, I see the smaller brand consolidation happening before another Starwood,
Yeah.
Marriott type.
For sure.
I'll go out on a limb, and this is based on absolutely nothing. Marriott Airbnb. Now, if it happens, you heard it here first. If it doesn't happen, forget I ever said it. That would be a hell of a combination, though.
It would be. It would be interesting, wouldn't it? I can't imagine that the owners and franchisees would be real thrilled with it.
Yeah.
I'm going to keep my mouth shut. Is this being recorded?
Given the size of Marriott and Hilton and the number of brands, do the brands that are not within the Marriott or Hilton portfolio, do they have a relative disadvantage? I mean, when you're looking at brands, do you rank them and say, well, I like this one, I don't like that one? As you're looking at branding assets?
Scale definitely.
I'm a big
Scale
Four Seasons
definitely.
fan, and
Four Seasons.
there's only 4 seasons
Fabulous,
within that
yes.
brand family.
Yeah.
I think scale matters, though, right? I mean, it's just you're loyal to Four Seasons because you kind of know that when you want that experience, they probably have something where you're looking to go, right?
Correct.
And there's a lot of other great like luxury hotel companies out there where, you know, if you're going to Hong Kong, like I am going to stay at the Mandarin, right? But like, you know, there are Mandarins everywhere, so it's just kind of tough to be loyal to that. So I think having that global footprint definitely is important. And again, I think that, you know, loyalty is still largely governed by people's ability to use it. I mean, the more you can use the program, like the more you're likely to be loyal to it. So I think scale definitely benefits that.
Well, that also assumes that there's no retrading going on the ability to use it.
Yeah.
And
Yeah.
There's a fair amount of that's going on.
What do you mean by retrading?
Retrading about the redemptions. I mean, the airlines do that all the time too, right? Aren't they always changing the rules on redemption qualifications?
Well, part of the loyalty program gives you an awful lot of knowledge about the consumer, and hopefully the brands can make some hay out of that, beyond simply all right, I got so many points because I stayed one night.
Now, by the way, I think to that point, and I'm surprised we haven't seen more of it, but maybe we will, because there's so much talk about like the leisure guests and the importance of delivering an experience and things like that. But like, why shouldn't Marriott be in non-hospitality businesses? Like you know your customers so well, but you know your ability to interact with them is so episodic, right? It's like you can't touch them every single day because not everybody needs to travel every day. But there's other things that they do. They work out, they need to eat, they watch TV. And so like, to me, like, I think the seismic shift, right? Will, and you see this a lot more on the casino and the gaming side of the business, where the gaming guys have actually realized that they're media properties and they're delivering content online to a lot of their customers. But the hotel and the travel industry hasn't figured out how to make that leap yet. But with the database and the knowledge that you have of your guests, and the fact that a loyal Marriott program member is somebody who inherently has discretionary income, like there's got to be something that you can do with that.
Yeah.
I think that would be amazing.
Yeah, there's things you can buy, there's things you can affiliate with to encourage people to buy from your affiliates and so forth.
Yeah.
Yeah.
Did
Well,
a pretty good job with credit cards.
Not to mention, I love those credit cards. Those fees are fabulous.
Payments business is great.
Yeah. What would you ask each other?
What are you guys working on?
Or maybe I'll put it a different
I
way.
already told you.
I'll ask the question the analysts always ask me. What should I have asked you that I didn't ask you?
Gary, you go first.
Yeah.
Highgate deal, the Highgate Core Point closed yesterday, and I know that all of you have been involved in some really big multi-property deals this year, right? So can you talk to us a little bit about what transaction efficiency in that context means? In other words, what's your strategy, particularly Larry, since you're sitting there too, and Dan, since you value them, right? So you come to the table, you've got all these assets. What do you look at? How do you look at the documents? What do you look as efficiencies? How do you structure the overarching agreement? What's in your mind when you go to the beginning of that process? Maybe Matt and Gary, you can lead on it. And then,
Well,
Larry, if you-
I'm not the investor, but there's two things about the Highgate deals, the Colony deal and the Core Point deal that struck me. One was that Colony had made an announcement publicly that it's getting out of the real estate, the hard asset business and moving to digital. And so putting aside the pandemic, for an operator like Highgate, who knows what they're doing when it comes to operations, to put in a bid from a company that is letting it almost like a zombie ownership because they focus their attention on something else, I think that is something that there's value add there that not everyone can bring. It's just not a financial buyer who can untap that, whereas a strategic like Highgate can. And Core Point's the same way. It's a public company. It announced it was selling. It was being managed by Wyndham. They knew where they were going to be terminated. And there's an opportunity there to maybe not change the franchise. They're all staying La Quinta, but for one, which is a Baymont. But there was an opportunity for a manager to come in, give it the attention it deserves that Wyndham knew it wasn't going to continue to give. And I think, to me, that's where the efficiency comes in, where you can find the right sweet spot for the right investor teaming with the right operator.
I think there is, especially with just so many deal makers in the room, we've talked a lot about just capital markets and inflation and like frothiness and all that. Like, there's definitely a lot of money out there, but the limiting factor right now in getting deals done seems to be people's time. And just like all of our hotel clients, like they're dealing with labor shortages. Like I can't imagine there's anybody in the room who isn't sort of feeling the pinch of just like, I don't have enough hours in the day or enough people on my team. And so something that I found is really helpful in transactions is just making sure you got your stuff in order and your ducks in a row, like early, like that early prep time. Because when I'm out there kind of selling an asset, what I say to all my guys is like, we got to make this super easy for the buyer who actually wants to do it. Because if you make it hard, they're just not going to spend the time on it. And so I find now that when we're prepping transactions for market, we spend double the time up front, just making sure we've got fully populated data room, like make sure the lawyers are on board, like as early as humanly possible, like talk about transaction structure, debate, right? Like we talked about this before on the other deal, like just what's the right way to approach the market and try to make that runway for a buyer and investor as easy as possible. Because I find now that we're not just looking for dollars, we're trying to help people figure out where they should spend their time. And again, like I've talked to many of you, like things are busy right now. Like I don't know anybody who's not felt the pinch of like, a missed dinner with a loved one or like a weekend that just gets blown up. Like things are busy. And so I find that the easier you can make it for transaction counterparties, like the better. And we are going to hit an environment here where I think that's just going to continue to pick up.
I think that's exactly right. And I think when things are as active as they are today, just that velocity, the pace at which everyone is operating, to your point, right? Buyers and sellers, really sellers need to have their ducks in a
Yeah.
row early and upfront, because the opportunity cost of wasting time on,
Yes.
on a deal while seller gets something sorted is so high. There's really not much appetite to say, okay, wait until we figure all this out. Okay,
Yeah.
I'm on to the next one. Right?
Yep,
Just, it has to be that way.
Well, Andrea, as a lawyer, you know that you work on a $50 million deal, single asset. You could work on a $200 million deal, single asset. It's the same amount of work, even though the price is higher. And so that's a very inefficient process for the single asset. With multiple assets, you've diversified some of the risk. You've got different locations. You've spread out. You've managed your risk by buying larger portfolios in one fell swoop. So it's super efficient to unload a large portfolio than to do one asset at a time. And to Larry's point, I mean, CorePoint was an interesting company because there were, and you can read all of the public filings they did. You should read the public filings because it was a very interesting process, but they had a lot of information ready, and it allowed for a very active real-time negotiation because of the volume of information that they had laid out ahead of time.
Dan, do you want to comment on valuation right now, where we're pretending 2019, 2020 rather than exist?
The question is, can you comment on the valuation environment, given that we're pretending 2020 didn't exist? Yeah.
I don't know whether I would agree that there's a pretending that it didn't exist. Again, the market is extremely active. There are, arm's length transactions that have been fully negotiated on individual sales and portfolio deals. And a lot of that has to do with, again, coming back to the enormous amount of capital that's out there that is chasing yield, right? And with the geopolitical uncertainties in the world, I believe that's only going to fuel more money coming into the United States, which still is and always will be probably the safest place on the planet to invest, into U.S. commercial real estate, and then drilling down further into hotels, again, because of this perceived hedge against inflation. So, listen, valuation is really a reflection of what the market is doing. And, the market knows what happened in 2020, right? The market is also seeing upside at this point, frankly, not seeing a whole lot of downside. And the question is, how quickly listen, there's a disconnect right now between operating fundamentals of hotels and pricing. There's no question about that. But at some point, that gap is going to close. How long that's going to take is anybody's guess.
I think about it just like from a very simple perspective. You look at capital formation, all these like private equity funds and institutional investors that take on third-party capital. And it's really their job to get it out. Like I talk with some of my friends in private equity, like I got to spend $1 billion this year, right? And so they are going to look for the best risk-adjusted return, and they just want to do a little bit better than sort of average of the market, so they can kind of get top quartile and things like that. But I mean, what we've seen as a result of that is that the expected kind of equity IRRs over time have just come down. Like I can remember just in the span of my career, like I sort of remember like if you're a private equity investor, you're supposed to be generating 25 to 30% IRRs. And now it's like mid-teens. And I think we're going to test sort of how low that goes. And then I just remember early in my career in the 2000s, like we can all remember when treasuries were trading at like 5%, but you had real estate trading at like 6 or 7. Like how did that really make sense, right? But they did it because that's sort of what their investors wanted to do. And as long as, I think there would be a fundamental shift in price if all of a sudden you started seeing like redemptions that we saw in hedge funds, right? Hedge funds used to be like just on fire, but clearly there's been sort of investors have been voting with their feet there, but then reallocating that capital to private equity. And I don't know just look at the list of private equity funds out there. I don't know a single private equity fund that doesn't have a plan to double in the next 5 years. Every single one of my clients is like, so what do you want to do? Like, I want to grow my business. How are you going to do that? I'm going to get into credit. I'm going to get into real estate. I'm going to have a buyout fund. It's like everybody's doing it. And I think the reason why this is happening is because that's what they're hearing from their LPs. Their LPs have more capital put to work. And so I think the great counter to sort of interest rates going up is that we're going to see some equity yield compression. There's kind of no other alternative. And if there isn't, it's because there's some other asset classes throwing off better yields, and I don't know that any of us know what that could be.
And also, let's face it, a lot of the what you described about, I have $1 billion, I have to spend it, right? if a professional is compensated on getting money out,
Right.
right?
They're gonna get the money
Compensation
out.
drives behavior, so I can invest $1 billion very easily.
Any questions? Well, given the conversation, Larry mentioned that time is the one thing we don't have enough of. I give you all 10 minutes. Thanks very much.
Thank you.
Great job.
Thank you very much.